A wave of anxiety is sweeping through global investors as a widespread sell-off in long-term bonds pushes borrowing costs in major economies like Japan and the UK to record or multi-decade highs. An alarming signal about the sustainability of government debt. At the same time, gold prices are soaring, reaching historic peaks as investors desperately seek safe havens in uncertain times. But here's where it gets controversial. Are governments losing control over their financial destinies? And what does this mean for ordinary citizens and global markets? On Wednesday, Japan experienced an unprecedented rise in borrowing costs, with its 30-year government bond yield hitting a record 3.255%. This spike followed a chain reaction that started the previous day when British gilts, US Treasuries and Canadian long-term bonds were also sold off heavily. What's behind this shift? Investors are growing increasingly uneasy about the ability of governments to manage their spiraling debt amid persistent inflation worries over the long haul. Christian Sewing, CEO of Deutsche Bank, bluntly summarized the issue at a recent conference. The necessary economic reforms to address rising debt levels are simply not happening, and financial markets are fully aware of this. He warned that unless political stability improves and meaningful reforms are implemented, this trend of rising yields and increasing borrowing costs may continue unabated. His stark assessment raises a fundamental question. Can governments genuinely shoulder these growing debt loads without destabilizing their economies or investors' trust? This challenging environment is playing out across several countries. In the UK, Finance Minister Rachel Reeves is expected to announce tax hikes in her upcoming autumn budget to steer public finances back toward her stated targets, signalling less fiscal flexibility. Meanwhile, France faces political turbulence as Prime Minister François Bayrou risks losing a confidence vote due to resistance from opposition parties confronting his proposed spending cuts. Japan, too, is feeling the strain. Government departments have submitted record-high budget requests, and key political figures, including aides to Prime Minister Shigeru Ishiba, have offered resignations after their party's disappointing electoral performance in July. The bond market data tell a clear story. British 30-year gilt yields climbed 6 basis points to a new high not seen since 1998, before easing slightly to around 5.67%. Germany's 30-year yields hovered just below their 14-year peak, showing the widespread nature of the pressure. Analysts are warning this could create a vicious cycle. As Japanese bond yields rise, Japanese investors, who for decades have sought higher returns from foreign government bonds, may shift their focus back to domestic debt, departing from a key pillar that once supported global bond demand. Ben Bennett, head of investment strategy for Asia at Legal General, described this as the perfect storm. He explained that Japanese investor behavior has historically helped prop up long-term bonds internationally. But with higher domestic yields, that dynamic is fading, leaving governments worldwide facing tougher financing conditions. These developments are not in isolation. The gap between short-term and long-term US government bond yields, the so-called yield curve spread, is near its highest point since December 2021. The 30-year US Treasury yield briefly surpassed 5% during Asian trading hours, unsettling equities as market participants brace for potential cross-asset fallout. Josh Chaston, a portfolio manager at Guidestone Funds, noted, "Crossing the 5% yield threshold is psychologically impactful on equity investors, and we're beginning to see that translate into market pressures." Currency markets have also been volatile. Britain's pound dropped to a 4-week low against the dollar before recovering slightly, while Japan's yen softened after a sharp decline the previous day. Despite these bond market jitters, European and US stock markets remain steady, buoyed by optimism about an anticipated US Federal Reserve rate cut later this month. Europe's stocks index climbed 0.7% and US SP 500 futures rose around 0.4%. However, Asian equities outside Japan fell modestly, with Japan's TOPIX index ending almost 1.1% lower, reflecting the domestic uncertainty tied to soaring government borrowing costs. Adding to the geopolitical and economic puzzle, European purchasing managers' indexes painted a mixed picture, highlighting sluggish growth in Germany and contraction in France. Businesses there are grappling with the lingering effects of former US President Donald Trump's unpredictable trade tariff policies. In a surprising development, the Trump administration recently requested the Supreme Court expedite a ruling on tariffs previously deemed illegal, prolonging their effect until mid-October. This ongoing tariff uncertainty dampened US manufacturing activity, which contracted for a sixth consecutive month in August, further weighed down by import tariffs. These economic headwinds contributed to a 1.9% drop in Brent crude oil prices, settling at $67.84 a barrel, underscoring how interconnected trade policies and market sentiment can influence commodity prices. Looking ahead, Friday's US non-farm payrolls data, preceded by reports on job openings and private payrolls, will be closely watched as crucial indicators of labor market health, a central factor in current Federal Reserve policy debates. The labor market strength or weakness could heavily influence future monetary decisions amid this backdrop of rising government borrowing costs and market volatility. So what does all this mean for investors, governments, and you? Are we witnessing a turning point where governments must confront hard truths about debt and fiscal responsibility? Or is this just a temporary market correction driven by political uncertainties and short-term fears? And here's a controversial thought. Could rising government borrowing costs force a rethinking of economic priorities, potentially leading to painful reforms that some political leaders and voters are reluctant to accept? We'd love to hear your take. Do you believe governments will successfully navigate these challenges, or is a fiscal reckoning inevitable? Share your thoughts and join the conversation below.